Hey there, everyone! Welcome back to our channel. I hope you're doing well today. If you're new here, my name is Your Name, and I'm thrilled to have you join us as we dive into the fascinating world of finance. Today, we're going to explore a topic that's crucial for anyone interested in trading or investing: margin accounts. So, grab a cup of coffee, sit back, and let's get started. But wait! You might be wondering, what exactly is a margin account and how does it work? Well, you're in the right place. Let's break it down together. A margin account is a special type of brokerage account that allows you to borrow money from your broker to purchase securities. This means you can buy more stocks than you could with just your own capital. But with great power comes great responsibility. So, let's dig deeper into how margin accounts work, their benefits, and the risks involved. First, let's clarify some terms. When you open a margin account, you're essentially getting access to leverage. Leverage is the use of borrowed funds to increase the potential return on investment. For example, if you have $1,000 in your margin account and your broker allows a 2:1 leverage, you can control up to $2,000 worth of stocks. This can amplify your gains, but it can also amplify your losses. Now, here's a quick example. Imagine you decide to invest in XYZ company, which is currently trading at $50 per share. With your $1,000, you could buy 20 shares outright. But if you use a margin account with that 2:1 leverage, you could purchase 40 shares. If the stock price rises to $60, your investment would be worth $2,400, and after paying back the broker, you keep $1,400, which is a profit of $400. But what happens if the stock price drops? Let's say the price falls to $40. Your 40 shares are now worth $1,600. After repaying your broker, you're left with $600. You've lost $400, which is 40% of your initial investment, compared to a 20% loss if you had only invested your initial $1,000. This highlights the main risk of margin accounts, the potential for losses to exceed your initial investment. It's crucial to understand that while leverage can increase your returns, it can also lead to significant losses. Now, let's talk about the requirements for opening a margin account. Brokers typically require you to maintain a minimum balance known as the maintenance margin, which is usually around 25% of the total value of the securities in your account. If your balance falls below this threshold due to losses, your broker might issue a margin call. This means you'll have to deposit more money or sell some of your assets to cover the shortfall. It's a way for brokers to protect themselves against the risk of lending you money. For example, if your margin account falls to a value of $1,500 and your broker requires a 25% maintenance margin, you would need to have at least $375 in equity in your account. If your equity drops below that, you might receive a margin call, forcing you to take action quickly. Now, let's look at some advantages of using a margin account. The first advantage is the ability to amplify your investment potential. As we discussed, leveraging allows you to purchase more shares, which can lead to higher profits. Additionally, margin accounts can improve your portfolio diversification. With more buying power, you can spread your investments across different sectors or assets, which can reduce overall risk. However, it's essential to balance these benefits with the risks. The volatility of the market can lead to rapid changes in your margin account's value, and you can be forced to sell assets at a loss during market downturns. It's a double-edged sword. Before we wrap up this segment, let's quickly touch on some key differences between cash accounts and margin accounts. In a cash account, you can only trade with the funds you already have available. This means no borrowing, which limits your buying power but also protects you from the risks associated with margin trading. On the other hand, as we've seen, margin accounts allow for greater investment opportunities, but with that comes the responsibility of managing your risks effectively. So, to summarize, a margin account is a powerful tool for investors looking to amplify their buying power through leverage. While it can lead to increased profits, it also comes with significant risks, including the potential for greater losses and margin calls. Understanding how margin accounts work and the responsibilities they entail is crucial for any investor considering this option. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more financial tips and insights. And let us know in the comments your thoughts on margin accounts or any questions you might have. Remember, knowledge is power, especially in the world of investing. Thanks for watching, and see you next time.